Okay, so hello to everyone. We are very pleased to be here with you today for another update webinar on ESG. We have around 900 registered participants for this webinar today. So that shows a real interest for that matter, and I would say for very good reasons. Our latest webinar took place in June this year, and since then a lot has happened again, and we are not at the end of the story. Today, around the table here, you have Laura Archange. Laura is in our banking and finance team, and she is an expert, notably in social bonds, green bonds, sustainability-linked bonds. And there have been developments in that area, and she will tell us more about it. You also have Antoine Portelange. Antoine Portelange comes from our investment management team, and he has been involved in ESG for quite a while now. He will update us on the latest legal and regulatory developments in that area. Also, Antoine Peter from our Arendt regulatory consulting team. Looking at ESG only from a legal and regulatory angle is very necessary, but is not sufficient. And other skills and backgrounds are necessary when it comes to implement ESG requirements. And Antoine brings us that different angle and that complementary knowledge we really need here. And myself, Isabelle Leb, I am a partner in the investment management team, and well, I am very involved in ESG as well. As always, there will be time for questions. Do not hesitate to submit them to us as they come to your mind, and we will be very pleased to answer them. So now, let's start, because there is a lot to say. First, a view of the market. What do we have? We see a strong move towards what we call Article 8 funds. You see that they represent 28% in the European market. It's less the case for Article 9 funds, with only 3%. As a refresh, Article 9 funds are those with an environmental or social objective. And that means a commitment towards an objective. And not everyone is ready for that yet. So that explains the low percentage figure. The Article 8 funds are funds with environmental or social characteristics. And that percentage figure we see here, 28%, does not really come as a surprise. There is a strong market pressure for funds displaying those ESG characteristics, and they do not go as far in terms of commitment as Article 9 funds would. Also, Article 8 funds is now understood as a very broad category. And there we see conflicting ambitions at the level of the EU legislator and supervisors as well. Because, well, on the one hand, the ambition is to capture as many funds as possible under Article 8. Why? Because, first of all, those funds, they integrate ESG characteristics. And the EU legislator wants that, likes that. Those funds also are submitted to increased transparency requirements, and that is also one of the ambitions of the EU legislator. So on the one hand, they are extremely tempted to transform that category into a very, very broad one and almost an all-encompassing one. But there are two risks to that. And the first one is that Article 8 category would become so broad that it would become almost meaningless. And the other one is that allowing funds with very low ambitions towards ESG to characterize themselves as Article 8. And that seems to be the case right now, at least the direction the EU legislator is taking. Allowing that, in fact, could facilitate mixed messages and greenwashing. And there we see the second ambition, the conflicting one, with a very broad interpretation of Article 8, which is greenwashing. And that is very much of a concern at EU level, as well as the level of the national supervisors. And you can see on that slide that several authorities like ESMA, FINMA, SEC have announced initiatives in that area. Greenwashing is something they've announced they will strongly fight. You also see that asset managers have taken initiatives in that respect as well. The idea, again, is always to make sure that we do not oversell what we can actually do in that area. And that explains also why, and that is something Antoine will tell us more about, why we are now experiencing delays in the delivery of the EU legislation we are all waiting for, very eagerly, because in fact, striking a balance between those two objectives, capturing as much as we can under Article 8 funds and fighting greenwashing, that is a difficult exercise for the EU legislator. And that is one of the explanations for why we are now where we are. And Antoine, maybe you can explain us where we are now precisely.
Yeah, absolutely. And just before going through the regulatory update, I wanted to remind you that we already tackled several ESG topics during our last webinar in June. We talked about the template RTS and the challenges related to those RTS. So concepts such as sustainable investment, sustainability indicators, portfolio breakdown. We also talked about the market approach to green bonds and other topics which can be interesting for you. So if you want to hear more about those topics, please do not hesitate to go on Arendt's website where the replay is available. And if you have difficulties to find the video, just send us an email or a message on LinkedIn and we'll provide you with the link. Now I will go through the regulatory update because there has been quite of a busy summer, and this slide presents you the background before this busy summer, and actually the four last squares shows the most recent publication that we will focus on now. And so this summer has been starting with very well-known news now. I will not surprise you when I talk about the delay of the RTS. So on the 8th of July 2021, the European Commission announced that the level 2 of SFDR would be delayed to July 2022. They are waiting for the final report on taxonomy-related disclosures in order to make one single RTS with the 13 RTS together, so with SFDR and taxonomy disclosures into a single document. The first indication we received was that we would have a new document published at the end of September. It goes without saying that we did not receive such document, so they are already a bit late. We see new rumors, new dates about December or Q1 2022, which is getting closer and closer to the deadline of July 2022. And which also maybe explain why there is a new rumor on the market, new words at the European level about the potential delay of the application of the RTS. So now we've been talking about the publication, but maybe also the application of the RTS would be delayed to later than July 2022. This comes from probably discussions between the ESAs. They have some discussions, some frictions on several points of the RTS they cannot agree on. So it's still a trending and pending subject. We hope to have more clarity and a definitive deadline as soon as possible because we keep pushing the deadlines. On our side, we still work on the 1st of July 2022 deadline. We do not count on a further delay. We still work on our clients on this deadline. And if at some point there is a delay, we will welcome it like you do. But for the moment, we still work on the 1st of July. Next big update was the publication of the European Commission Q&A on the interpretation of the SFDR. This also made a lot of noise on the market. Why? Because first there has been a lot of critics coming from the market and to be honest also from us. Because maybe you've seen it, but the European Commission states clearly that this Q&A does not intend to add any additional obligations to the SFDR. But there are some very game-changing points within the Q&A, which, for example, the application of the SFDR to non-EU and registered AIFMs, the classification of Article 8 and Article 9 products, the definition of promotion for Article 8 products, and this comes as an echo to what Isabel was saying before, and also interpretation of Article 9.3 of the SFDR and the use of CTB and PIB benchmarks. So those topics have been very criticized, and actually we did not see so much impact coming from this Q&A because we've been waiting for the regulators at European or national level to react to the Q&A, and they've been very quiet. The industry as well was a bit shocked when they read the Q&A, and so at the end of the day, nothing really changed. We are still waiting, and the direct operational practical impact has been very limited. So we'll see if there is a reaction in the future, but for the time being, it's still quiet in this respect. So that's for the two big updates for the Commission and the SFDR RTS. And I will now give the floor to Antoine for more taxonomy-related information.
Thank you, Antoine. Yes, indeed, also a lot happening on the taxonomy side of things. So it's what you have on the bottom of your slide. So starting with the first type of work on the taxonomy framework is on the rules. So on the rules themselves. So on really the criteria within the taxonomy under which you can consider that the conduct of an economic activity is environmentally sustainable. So the first line relates to the screening, the technical screening criteria which we had been given just before the summer for the two first environmental objectives of climate change mitigation and adaptation. So this is a delegated regulation from the Commission. So it has to go through a scrutiny period by the Parliament and the Council of 4 months. They were notified on the 7th of June, so the scrutiny period ran until the 8th of October. And they have asked already for an extension of this scrutiny period. So this is the take it or leave it moment where the Parliament, they're not supposed to change anything, but they can still reject the delegated acts. So it's there, but it cannot be officially published until we have the final approval from the Parliament and of the Council. So they ask for an extension of 2 months, so that pushes us to early December. For a set of rules which is supposed to apply in January afterwards. So then that's a very short time frame. On the other hand, completion of the rule set also with a consultation on the same rules but for the other objectives. So we're covering the same economic activities, but this time how they can contribute to circular economy, pollution prevention, healthy ecosystem and sustainable use of water. So here it's public consultation, which ended just at the end of the summer. So you had an opportunity to challenge the technical screening criteria. I'm not sure, as an industry, the fund industry had a lot of, chance or knowledge to, because it's very technical. It makes reference to really operational regulation on each of the sectors. So this is ongoing. So here we are finalizing the initial framework or the initial rule set of the taxonomy. In addition to that, we are already thinking on how we can expand the framework and how we can extend the framework of the taxonomy. So 2 work streams to extend the framework. First one is social objective and social issues. So we have had, there is a specific body at EU level, the European Platform on Sustainable Finance, which is responsible for developing the taxonomy framework. First work stream is to have social objectives. So they came up with a proposal on how we could have criteria for significant contribution or significant harm for activities which would contribute to social objectives. So you had a chance to comment, AIFMD answered the consultation, and so now we will have a final report quite soon on this. The other work stream to expand the framework is to extend the taxonomy to also transitioning activities and also activities which are not significant for the environment. The point here is that today the taxonomy is a bit is very binary, because either you are aligned or you're not aligned, because you do not significant harm and you significantly contribute. We're trying to have a bit more granular and refined classification system here, where potentially you do not significantly contribute, but at least you do no significant harm. So this type of thing. So it's very much about making the taxonomy yet more complex than what it already is. You also had an opportunity to comment on this, and we worked on this with Alfie as well. And last but not least, we had over the summer, still on the taxonomy, the level 2, so the delegated acts on the article 8 of the taxonomy. So the article 8 of the taxonomy is not the SFDR part, so it's not the product level disclosure regarding taxonomy. It is the part which says the taxonomy directly applies to non-financial entities in the EU which are subject to the non-financial reporting directive. So it's the part that says the taxonomy, it impacts the financial sector, but it also impacts directly operational companies. And the delegated acts under the Article 8 explain how an operational company is supposed to report its own taxonomy alignment based on the various KPIs that we know, so turnover, CAPEX, and OPEX. It's very technical. You have also a template to report this. But what is mostly interesting in there are the deadlines. So where we will have a word on the reporting afterwards, but when we talk about sequencing issues, this is what we're talking about. Under the Article 8, so when we're talking taxonomy applicable to underlying companies, we are looking at an horizon to 2023, 2024. There will be some qualitative data before, but the hard quantitative alignment is for later. So we have an issue because the Article 5, 6, 7, so the taxonomy which applies to the funds, it becomes applicable much before. So this is where we struggle, because the fund industry is asked to be transparent on something which will become applicable to underlying companies a bit later down the line.
Yeah, absolutely. And talking about the fund industry in Article 5 to 7 of the taxonomy and the challenge as regards the fund industry, there is the need now to start preparing the taxonomy level 1 disclosures for the 1st of January 2022. This is the next focus, the next challenge in terms of disclosures. And I will give you a short presentation about those requirements, not going into too much details because, as you can already hear and understand, everything is getting more and more technical. So basically, all funds will have to add disclosures in their pre-contractual documentation with respect to their potential alignment with the taxonomy. Now, this is rather challenging because we don't have many guidance in this respect, apart from these 3 articles that I've produced on the slide. For Article 6 funds, it's pretty easy. So it's Article 7 of the taxonomy. It's pretty easy because there is only a disclaimer to add into the documentation. This disclaimer basically states that the fund is not aligned with the taxonomy. It's an ESG fund, it's an Article 6 fund. And this disclaimer is supposed to be copy-pasted without being adapted. That's the principle, because it's a quote. We see some adaptation, nevertheless, because sometimes it doesn't go perfectly into the prospectuses. Now, for the Article 9 products, it starts already to be a bit more complicated. So for Article 9 products, it's the Article 5 of the taxonomy that is applicable. And it states that only Article 9 products with environmental objective, so that invest in an economic activity that could contribute to the environmental objective, must comply with the Article 5 of the taxonomy, which basically says that you must give the objective you want to contribute to, and how and to what extent you will contribute to that objective. But it's only applied to environmental Article 9 funds. So it means that for social Article 9 funds, they are not covered. So they should in principle not do any disclosures with respect to taxonomy alignment for the time being. So this is already something a bit strange to read, but it's only the start, because now if we look at the Article 8 products, it becomes a real mess. I will not go into too much details, but basically Article 8 products with environmental characteristic are supposed to apply also the Article 5. So if you have an Article 8 products that promotes environmental characteristics, you also have to apply the obligation I just mentioned under the Article 5. However, sometimes Article 8 products have ESG and environmental characteristics, but they do not have under sustainable investment in their portfolio. So they cannot really answer to the questions under Article 5. In addition to that, they have to add a disclaimer, which is this one, and that can be completely conflicting and inconsistent with the information you just provided for the Article 5. Long story short, it's actually a mess, and there are lots of inconsistency and contradiction between the articles. And so we came to, let's say, reasonable approach, reasonable solution with the industry, with several clients. We talked, we brainstormed. And what we are trying to do now is just to have the disclaimers included in the documents so that we are a minima aligned, compliant with the obligations. But then we cover those disclaimers with high-level information that reduce the consequences of the contradictions. And we understand that the regulator will not be against this approach. We understand that they will probably take the same approach as they did for the level 1 of the SFDR, which is basically allowing for high-level information and then the freedom to with respect to how you will present those high-level information. We have not tested this a lot yet, but it seems to be the approach the market is going to take. Now, we are very interested in your approach to that question because we presented our approach, and we have prepared a new set of polls this time. We know that it's been a huge success to have your words, your approach to the question we are presenting. So we have prepared a few questions for you guys if you want to answer it. And we're basically wondering if you have started preparing the taxonomy level 1 disclosures, or if you plan to do it at all. And then if you have started working on taxonomy, we are wondering whether you have been able to calculate your taxonomy alignment, which is also a big challenge. So I will start the poll now, and I will leave you a few seconds to answer it. And it's really interesting because we did basically the same poll on taxonomy alignment in June during our last webinar. And so we will be able to see a bit the evolution with respect to taxonomy alignment and whether you try to, and you are now able actually to make improvement in that respect.
And maybe in the meantime, we can quickly answer the question we received in the chat, which highlights exactly what we were underlying on the slide. So we had a question on what happens if I'm in Article 8 with environmental characteristics, but I do not have investment which meets the definition of sustainable investment. So that's exactly the point where you will struggle because you're in scope of Article 6, so you need to apply Article 5 and put the disclaimer. When you apply Article 5, you will say that you don't have any, because as you just said in the question, you don't have sustainable investment, so let alone taxonomy aligned investment. And then you need to put a disclaimer saying that the do no significant harm principle only applies to the part of the portfolio which is not made of sustainable investment, which effectively is the whole portfolio because you do not have a part of sustainable investment. So this is the point where we would help you with putting it a bit into context and explaining a bit, how you end up with a situation where you need to put this disclaimer because it's given to you in the level 1 of the regulation, but it does not really fit or make much sense for your portfolio.
Yeah, exactly. I'm closing the poll now, so we'll have the result in a few seconds. And I will not spoil, but I already have the answer in front of me. And it's interesting. Can I share it? Yes. So on the question, have you started preparing the taxonomy level 1 disclosures?
You need to apply.
Yeah. I need to apply, sorry. Yeah. Here now you should see it.
Everyone can see it. Hopefully you can see the results. But
yeah, if you cannot see it, please send a Q&A and I'll change the approach. But so basically what we can see is that it's a 50-50 answer on whether you are actually preparing or not the taxonomy-related disclosures. There are 8% that will not do it at all, which is also an approach we are seeing on the market, we must say, because as for the level 1 of the SFDR, there is no sanction in the text, in the regulation. And since the industry is not moving super fast, we can already see that some of the market participants will not be compliant with the regulation on the 1st of January. So it's a 50-50 for the first question. And then on the taxonomy alignment, we can see, okay, there is 94 of no, and then a few yes and different approaches. Most of the yes are below 15%, which is also pretty much in line with what we see. But still, most of the participants have answered no, and we can also completely understand that because, as Antoine said, we do not have the final technical screening criteria, there is no data, there is problem in timing because the non-financial companies that are supposed to give the information will not do it until a few years. So it's completely understandable, and be reassured that the others are in the same situation and we are all in the same boat here. So that's it for the taxonomy level 1.
Okay.
Yeah.
So as you can see, taxonomy will be a challenge. There is another one ahead of us, which has to do with reporting, and I guess this won't come as a surprise to you. There are a lot of discussions around this on the market, and I must say that it's not totally clear. So Antoine, could you explain to us what we have to do at this stage and in the next future?
Yes, absolutely. So indeed, the second immediate action plan, which is coming rather quickly, but which is challenging, is the periodic reporting. So when we talk about periodic reporting with ESG, SFDR, we need to first clarify what we are talking about. You have 3 different types of reporting. The first type of reporting, which is the one I will focus on today, is the annual reporting. So under SFDR, the level 1, if you promote ESG characteristics, if you have a sustainable investment objective, you need to report, you basically need to show how you made good on that promise and on whatever you promoted in the fund's documentation. And this impacts Article 8 and Article 9 funds, and where this information goes is in the annual report of the fund. The second type of reporting is the adverse impact reporting. This is the PASI or PAI. At some point, someone needs to, we all need to agree on whether we call it PASI or PAI. But it's the adverse impact reporting. So this is if you have chosen to be transparent and if you have opted in, or if you have to do it under the Article 4, then you take the list of indicators of the level 2 and you report on those indicators. So that's the PAI statement. That's another type of reporting. And the last type of reporting is the taxonomy alignment. So the taxonomy alignment is actually twofold or threefold. Either you have the taxonomy alignment at product level, because you are an Article 8 or an Article 9 with sustainable investment, with environmental objectives, so you have to do taxonomy alignment at product level. It could be taxonomy alignment at entity level, so this is the either company level if you're a non-financial undertaking, or even company level if you are a financial undertaking subject to non-financial reporting directive. So if you're a big bank or this type of thing, you have to calculate the green asset ratio, and that covers also lending portfolios, trading portfolios, and this is not the alignment of the product, it's the alignment of you as an investment firm, as a bank, and your whole activity of financial undertaking. So 3 types of reporting: annual reports, adverse impact, and taxonomy. On the annual report one, which is the one which is coming quite rapidly, first we had sort of a confirmation from, so what we have confirmation is that the European Commission takes a very legalistic approach and view of the reporting deadlines and considers that, if you read the regulation, every annual report which is published after the 1st of January 2022 has to comply at least with the level 1 of SFDR. So that's the Article 11, where we are asked, please explain how you have achieved the characteristics, or please report the sustainability-related impact of the fund for an Article 9. So this means, and what is sort of interesting and new, is it's regardless of the investment period. So every annual report of a fund that comes out after the 1st of January has to apply level 1. That's not so much of a shocker, it's not very new. We had always anticipated it. At some point we wanted to argue that because the regulation entered into force only in March, there was an element of retroactivity. But overall, for 2021, report on level 1, it's also not to worry about too much because it's high-level principle-based, so it's free format. You can have qualitative information, you put whatever you want, it's just reporting on what you promised. What is more worrying is the level 2. And here, Commission says they're taking the same very legalistic approach, and they say, if the RTS enter into force on the 1st of July, every annual report which is published after the 1st of July has to use the template which is given in the level 2. So we talk a lot about the template for the pre-contractual disclosure, which is what everybody is working on at the moment. But in the level 2, you are also given templates for the periodic reporting. And if you take the very strict view, it means that every report that comes out after the 1st of July has to use the level 2 template. So when you receive the slide, because we also had a question, you will get a chance to read the little characters on the right bottom slide that insist on the fact that there are significant practical issues to that approach. Because if I want to report using the level 2 template, I need to know exactly what I have to monitor, what I have to report on. And so it's very difficult from a practical and operational point of view to say that everything that comes out after 1st of July will use the level 2 templates. And I think at this stage, Commission was not so, they were not so keen to understand this, but they say that they will review the reporting and the timing once the RTS are finalized. So there is still probably a good chance that we can at least push the level 2 reporting for everything that will, let's say, come out in 2023, reporting on the year 2022. But at the moment, if it stays as it is, we can only strongly encourage you to publish the annual report before July. Otherwise, it's going to be much more complicated. Yeah, so that's where we stand today in terms of reporting. So, yes, thank you for showing me the board. The last point on the reporting is that what transpired from the Commission, the discussion with the Commission, is that the RTS would stay, and I will quote because I don't want to, largely the same. That's what is being said. So the template will remain almost exactly the same. And apparently the Commission, the European Commission, and it's also what the CSF is doing in Luxembourg, they really encourage the markets to already use the level 2 templates, be it for pre-contractual disclosure or for reporting. Because they say, there are some issues on the level 2 between DSRs, but we understand it's mostly on the taxonomy-related part, and which means that the SFDR part of the level 2, so the pre-contractual and the reporting, will remain almost exactly the same. And so they really encourage you to already use the level 2. So our question to you is, do you plan on already using the level 2 reporting for your reports you will issue in 2022? Which, if they stay the same, we already know the rules because we have been given the templates. So it is, for the moment, surprisingly tight.
Yeah.
Which is, the CSF will be pleased.
Yeah.
And I guess everybody will be pleased because it's such a, it's a massive work. So the earlier you start with the level 2, the better.
Yeah, and you have the opportunity now to test it, really. So we also encourage you, of course, trying to fill those templates, be it again at the level of the pre-contract disclosure or the reporting. Okay, I see it's not moving anymore, so 20 more seconds to answer. You can ask your colleague very quickly whether you will do it or not, but 14 more seconds.
But it's interesting to see also on the slide, and what also transpired from the discussion in the Commission is the adverse impact reporting, at least the quantitative part where you need to measure the indicators. This potentially will be way down the line, because under the level 2, it's foreseen that it's the average of at least 4 calculations during the year. So you'll have to measure 4 times in 2023, and then you'll report for the first time in 2024. But you will still worry about adverse impact indicators and measure them way before that, because if you want to argue that you have sustainable investment, you need to explain how you consider adverse impact. So even if it will not be the strict reporting under the adverse impact statement, you will for sure measure it way before that to demonstrate that you have sustainable investment.
So we have the result, and I shared it so you can see good proportion of yes, and this is very interesting to read.
Yeah.
So there are some motivated market participants that want to try, and that's very, very good, I think.
That is very wise. But it's quite a significant piece of work, and the earlier the better. Okay, that brings us to Laura, because there is a lot to say about ESG bonds. So Laura, maybe give us an update of where we are, because a lot has happened this summer.
Sure, Elizabeth, thank you very much. So when we discussed during the previous webinar back in June, we mentioned that green bonds are definitely an attractive class of assets, given that if green bonds complying with the green bond standard would count for 100% of their value in the calculation of the taxonomy alignment. But over the summer, we received finally this proposal for regulation on green bond standard, and also the ICMA, so the International Capital Market Association, updated several of its principles, of its bond principles. So the idea during the next few minutes is really to take an helicopter view and to look at the various label bonds that exist in the market, whether they are green, social, sustainable, sustainability-linked bonds. Basically, let's take the approach from an issuer perspective. So we will first look at the issuer perspective, and that will enable us to better understand what, as an investor wanted to invest in this kind of bonds, you need to check and what you need to take care about. In terms of the purpose of a bond, if you, as an issuer, have the intention to issue bonds, you will use it to finance or refinance your business activities, so it being infrastructures, real estate, capital expenditures. Now, let's look at the sustainability-linked bonds. You will see that it's the same. So if you intend to issue a sustainability-linked bond, you can use the proceeds from the issuance of such bonds to basically finance your corporate purpose. There's no restriction. You're not obliged to invest only in social projects or in green projects. That's really broad. But the difference with, let's say, a more common standard bond is that the bond characteristic will vary depending on whether the issuer meets some KPI, means some ESG KPIs. So that's the really interesting thing about that. And talking about numbers, you can also see that while the, let's say, mainstream bond markets represents almost $100 trillion, there's then some place for sustainability-linked bonds. And I will take just one example which really illustrates that point. So recently, Novartis, the healthcare group, they issued through their Luxembourg-based company a sustainability-linked bond. One of the purposes of the bond is to grant greater access to the medical innovation to various patients in low-income countries. And one of the criteria of this bond is that if Novartis they don't meet their KPI objectives, then they will have to pay an increased coupon of 0.25%. So there's really an incentive for this company to comply with its ESG objectives. So you should make sure that you do not mix sustainability-linked bonds with sustainability bonds, which are totally different. So if we looked at the sustainability bonds, they consist in a combination of green and social bonds. It means that the issuer won't be allowed to use the proceeds from the bond issuance for its general corporate purposes, but it will have to invest in green and social projects. Again, as a matter of example, I can take the issuance by Medernach, again a Luxembourg-based company who is providing fixed and mobile services in Latin America and Africa. Going now to our next subject, and where we receive further guidance from the European Commission. So when we discussed back in June, we were working more on the ICMA green bonds principles. Now on July, we had the release of a proposal for a regulation of green bonds. And the important thing to consider is that it's really taxonomy aligned. So as part of the definition of what is a green bond under the green bond standard, we will see that all the criteria are aligned with the taxonomy, such as the purpose of the proceeds relating to economic activities which are sustainable. We have also this do not significant harm principle. We have to meet the minimal safeguards, etc., etc. Maybe Antoine, you want to say?
Yeah, I think this is interesting because for two reasons. First, you see how, or three reasons. First, you see how the regulation or this tendency to regulate this area is expanding to other areas. Second, you see here a very good example and use of the taxonomy. So the taxonomy is a tool. It's not a mandatory list to invest, it is a tool. And so the difference with a green bond and a green bond with the EU standard is just that the underlying projects that I will finance have gone through the taxonomy exercise and they are taxonomy aligned. Otherwise, I cannot finance them, or I could, but just under a green bond with the green, in line with the green bonds principles, but I would not get the EU green bond standard. So this is where you see how you can use the taxonomy to really as a filter. Mm-hmm. And indeed, it's interesting for the fund industry because the underlying project of such green bonds had to go through the taxonomy screening and exercise. Then, when you as an investment fund or investor invest in that bond, then you can indeed consider that that position in such bond can be considered as taxonomy aligned when then you as a fund calculate or have to be transparent about your own taxonomy alignment. So it's really that.
Yeah.
Very simple.
Yes, and this definition is rather precise. And in terms of figures, we also notice that the green bond markets is already huge. So we have, as per Moody's expectations, in 2021 we will have $450 billion of green bond issued. As we talk about Luxembourg, one of the major issues was made by Blackstone Property Partners Group Holdings. So I'm just talking of public information in case you worry about that, but that's publicly available. And finally, in terms of label product, we have also the social bonds. So when an issuer issues social bonds, it needs to invest the proceeds from the issuance in social projects. So unfortunately, we do not have any social bonds issued in Luxembourg. But I think it's interesting to notice that earlier this year, JP Morgan issued a social bond for more than $1 billion. So that's really a huge amount and really a good sign for this market.
And maybe just on the social bond, it's interesting to note also that at the moment there is no EU social bond standard because we don't have the social taxonomy. And right. The EU green bond standard relies on the environmental taxonomy. So the day we will have a social taxonomy, then we can also come up with a EU social bond standard.
Yeah. Yes, thank you, Antoine, for the clarification. In terms of framework, as mentioned, none of them are mandatory, but these are voluntary framework that you can use. I mentioned some of them in the in the second line of the table. We'll send you the slide, and so you will be also able to have further information. So it enabled me to go directly to the third line, which relates to the key aspects, documentation, and process for each of these kinds of bonds. The good thing is that the requirements are more or less the same for each this kind of label bond. So if you took the approach of the standard bonds, if you have an issuer wanting to issue a bond, it will look at the yield, maturity, the duration, the credit rating, the ranking. So that's the usual, the standard features for each bond. Then, if you are going into a label bond, you will add layers of complexity, let's say. One interesting example is about sustainable linked bond. So, because for this kind of bond, the idea is not to use to finance social or green projects, it means that the approach is a bit different from what we will see thereafter. Here, the issuer will determine KPI, it will determine targets in order to show investors its ambitions towards ESG compliance. And so it will determine the objectives in terms of sustainability compliance. So the approach is a bit different on that compared to the one taken for green and social bonds. Then in terms of reporting transparency, we have more or less all the same points, meaning that pre-issuance and post-issuance, the issuer will have to publish reports, and such reports will be reviewed by an external reviewer. Really the new thing about that, which is mentioned in the proposal for a regulation on green bond standard, is that if that regulation is adopted, then the external reviewers will be supervised by ESMA. So there will be a register, they will have to comply with substance requirements. So there will be supervisions also dealing with conflict of interest issues. So that's a major stone on the proposed regulations. Then, and I won't take a lot of time but on that one, but one thing you need to note is that bonds may be listed or not. In terms of listing, you will need to look at the, let's say, common features, the common rules for listing, depending on the nature, on the form of the issuer, whether it's a securitization vehicle, whether it's a fund or just a corporate. So you will also need to take into account whether you want the listed market, the regulated market, whether you want just Euro multilateral markets, or whether you want to issue the bonds and market them via the private placement rules. If you're going for a label bond, so it being sustainable, green, social, or sustainability linked, in Luxembourg, we have this Luxembourg Green Exchange, and I just take the opportunity to clarify that even the name refers to green kind of product, it's open to all the ESG, let's say, kind of bonds. And so this leads us to say that if then you're thinking from an investor's perspective, I mean, if your portfolio manager contemplates investing in the kind of sustainable debt product, then the question comes, what do you need to check? And we saw that the aim really of this regulation, the proposal for a regulation, the aim of the principle is really to have a kind of standard harmonized market where we have harmonized reporting rules. And so that will definitely help you in your due diligence. There's one other tricky question about that, Antoine, do you want to talk about that?
Yeah, I think we're not going to do the poll because we're out of time, but the point is, the green bonds, the point we wanted to make is, when we have the green bond standard in place, it's easier for us as for the fund industry, because you know that the use of proceeds has been checked against the taxonomy. So you can consider that as taxonomy aligned, and you can consider that as sustainable investment. The point, if you read the sentence the other way around, is until this is available, when you invest in a green bond, it does not necessarily mean that the underlying investment are sustainable investment as understood in the SFDR. Because if you remember the definition of sustainable investment under SFDR and the taxonomy, you need to contribute to environmental or social objectives, and also do no significant harm. Traditionally, when you will have the report on the green bonds, they will indeed report on how they use the proceeds, they will report on how they contributed to objectives, and they will have something on how they have made sure that there are no negative externalities and that they did not do significant harm. However, it's not guaranteed that they will report all the 14 mandatory indicators for adverse impact, which are the indicators you have to look at to be aligned with the DNSH definition under SFDR. So until the Green Bond Standard framework is finalized, which maybe will still take a while because this is just a proposal at the moment, we just wanted to say be cautious when you invest in a green bond and really look what type of information is coming up from the investment, so that you can screen it against the SFDR framework to effectively calculate how much of that green bond meets the definition of a sustainable investment under SFDR. It's not just a package where you take and it's fully sustainable investment. And same for the taxonomy. So until the Green Bond Standard is out there, you should screen underlying projects and see how much the underlying projects are taxonomy aligned. And so you will have green bonds that will be more or less taxonomy aligned. And this is what you want to look at.
Okay. Time now to go to your questions. And we have a number of them. We'll try to answer as many of them as we can now, and for the other ones we will get back to you so that you all get an answer to your question as much as possible. But thank you for those questions, very, very interesting ones.
So who wants to start?
I can take this one.
Take the easy one.
Okay.
I can take the easy one,
It's never easy, but...
That's very true, but there's a question that asks whether the annual report for Level 1 is only applicable for Article 8 and 9 products. Well, yes, because only Article 8 and 9 have to report anything about ESG according to the SFDR. They have to report if they are Article 8, whether they achieved the characteristic they promoted, or if they are Article 9, whether they achieved the sustainable objectives they have disclosed. So if you're Article 6, so you don't have neither ESG characteristic nor sustainable investment objective, you do not have to make this reporting in your report, be it at the Level 1 or the Level 2. It's not covered at all under Article 11 of the SFDR.
Yeah, but there is a revision of there is a revision of UCITS and AIFMD to make sure that you systematically take into account sustainability risk when you in your operation, including risk management frameworks, and there will be some reporting at some point on the exposure to risk, and it's something you will have to systematically look at and monitor. So SFDR Article 8 and 9 is just when you go beyond integration of ESG for risk management purposes and for safeguarding the financial value. When you go beyond that and you promote or you have a specific objective, then report on how you achieved it. But then just the risk part, it will come, it's from a different piece of regulation.
So maybe another one. Just trying to read them.
So the first one was on whether, so the question is rather long, and I understand that we are seeking a confirmation that SFDR applies to managed portfolios and not only to insurance products. So that is correct. So discretionary mandates and managed portfolio, they are in scope of the financial products which are covered by SFDR, which is potentially tricky, especially when it comes to website disclosures, because you have conflicting confidentiality obligations with your client for which you have the discretionary mandate that conflicts with the website's disclosure obligation of SFDR. So here you need to work on a practical solution with maybe a password protected or something which is available on request. So here I think a sensible practical answer to that challenge is well accepted in market practice.
I'm just thinking whether we have also questions in the chat before we answer this one, because we do have a lot of questions in the chat.
We had this question also about the Q&A and how that Q&A that is the result of the questions asked by the ESAs and the answers provided by the EU Commission. Well, it's not really easy to understand, and it's not really easy to apply, and I'm being very moderate in what I say here. In summary form, what I would say is that no one understands it, and no one really knows what to do with it. Our approach here is don't apply it as long as this has not been somehow formally endorsed, be it by ESMA or be it by the national supervisory authorities. There will be certainly clarifications, and clarifications will come either from the EU Commission or from the ESAs themselves. If you look at those answers in detail, in fact, you see very contradictory messages. And that is why it's not really easy to understand. I see this question, for example, about Article 4.4 of SFDR and this obligation to disclose the principal adverse impact when for large groups or large undertakings, and the question whether it applies only at the level of EU domiciled parent undertakings, and the question is, would that not apply then to non-EU domiciled parent undertakings? Well, the answer is, sorry, it's a lawyer's answers, and you won't like that, but it's not clear at all. Especially also because the EU Commission, in answering those questions, stated very clearly that they do not aim at creating new legal obligations or somehow or in any way changing the interpretation that has to be given to level 1. And level 1, in Article 4.4, does not make distinctions between EU and non-EU. They're very broad. So if we want this to really be understood in a very narrow way and in a more reasonable way, then we need to wait for further clarification. Unfortunately, this really was a missed opportunity. I have to say that. I'm not very pleased to say that. It was a missed opportunity for the EU Commission to come with clarification, which is not really the case here.
Yeah, I just see that there is a question about the definition of sustainable investment under the taxonomy in the SFDR, and it allows me to do the promotion of our previous webinar, because this is a question we discussed largely during the June webinar. So please go check the video, the replay that is on our website, and I think you will find all the answers needed. But in a few words, if it's possible, basically the SFDR is more free in terms of sustainable investment. So you fix yourself what is your sustainable objective, and then you make investments that are in accordance with that objective. And so it's a sole and let's say evolutive concept. It's broader as well. It's broader. Exactly.
I think an easy way to visualize that is think about taxonomy-aligned investment as a smaller subset of sustainable investments. So you could be a sustainable investment, but maybe you have a social objective which is not covered by taxonomy, or you invest in an economic activity which is not covered by the taxonomy. So there can be a lot of good reasons why any given investment still meets the SFDR definition, which is I contribute, I do no significant harm, and I have minimum safeguards, but it's not taxonomy aligned. So many good reasons why this could happen. But if you have sustainable investment objective with environmental objectives, you have to calculate alignment with taxonomy, and then you have a smaller subset of taxonomy aligned investment. So how does this reporting published after 1st of July affect Article 6 fund? So I think we answered Article 6 funds, they do not have to worry so much about this, because this is very much for Article 8 and 9 products. Mm-hmm. So that's a long question, sorry. So, do you have any update? I take the short one while you finish the reading of the long one.
Yeah.
Do you have any update on whether a fund can report on only certain mandatory PASI indicators and get an exemption? No, I mean, not that I have heard. I think the list has been significantly reduced. And from what we hear overall, the information is there. Although it's true that the initial list was quite long with the 30 indicators, overall I get the feeling that our clients, they get the information for the 14 remaining. So at least the mandatory bits, that's I think if you say you make sustainable investment, it will be hard to get out of at least the list that is in the table 1 of the Annex 1 of the RTS, so the mandatory parts.
No exemption foreseen so far.
Yeah.
So we will have to hurry up, and maybe we'll stop here so that we finish on time, unless we may answer very quickly to the long question.
It's very long. There are several sub-questions, so
okay.
I suggest that if you have very long question and more complicated
we
one.
get back to you in
Exactly.
writing regarding this one, because we don't want to lose everyone else's time. And thank you all for having been listening and watching us. Thanks to the panelists today. Well, I told you before, it's not the end of the story. So you will hear us, you will see us, I think, again, probably a number of times. We plan on organizing another seminar somewhere in January. So that is being, it's being planned right now.
Hopefully we'll have the
In
level
the
2.
meantime, yes, hopefully we will have more clarity or very clear messages to share with you. In the meantime, you will see videos from us. There will be a number of videos on our website. So don't hesitate to come and visit us. We have a number of them being prepared right now, each on a very specific ESG topic that may interest you. So
And next week we take part to the LuxLag Sustainable Investment Week.
Yeah.
And we will have on Thursday afternoon a session. It's a quick session, 45 minutes, on carbon credits and carbon offsets, which is quite a trendy topic at the moment. We see a lot of clients interested in knowing, what they are, how they work, how they can use it to compensate the carbon footprint of their products. So, a quick, interesting session on that next week if you're interested.
So again, a big thank you, and well, have a very nice afternoon and a very nice weekend.
Speak to you soon. Bye.
Bye.
Yeah.
Thank you, bye.
Bye.